Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is Yahoo Finance senior reporter Allie Canal, who's here to keep the discussion honest and easy to understand. And with the big Fed decision still in focus, we're asking how a shift down in market rates meets an AI-fueled earnings boom and what that means for your investments. Our word of the day, dispersion. Winners win, losers lose, and the gap between them is only growing wider. How to pick the right side of history for your portfolio. And this episode is brought to you by the number 1,045. That is how many tons of gold that central banks bought last year, how the perfect storm of rates and uncertainty is sending gold to record highs, not to mention a 40% return this year alone. And today we are welcoming Michael Gates. He leads BlackRock's model portfolio solutions in the Americas, designing ETF-based solutions that are used by advisors and everyday investors. He connects stocks, bonds, commodities, even crypto into one practical playbook. If you care about AI earnings and rates and how they translate into actionable mixes, this is your guy. Michael, by the time this airs, the Fed decision will be history. We don't know what it is, but let's just start with your big picture overview of the markets right now and how you're seeing things.
Yeah, I think the thing to know about is the economy and that's growing. The U.S. economy is growing at about 2%. You have to look closely at the numbers to figure that out. The GDP numbers year to date for the first half were 1.5%, but there's another number called GDI, which is gross domestic income. And if we remember college macro, if we attended college macro, we would know that GDP and GDI should be the same. Well, they are over the long term, but they reporting period to reporting period can be a little different. The GDI is giving a hotter number than the GDP. And it's about 2% for the first half of the year. And that's despite what was happening in the government with layoffs, with trade policy changes. So we think that that's a good sign. And current data coming out recently also looking okay.
Yeah. And, it sounds like there might be a little dispersion between those two numbers. But that's not really what that is our word of the day. And I'm going to break it down right here. But typically it means something else in investing, which is how much returns differ across stocks, sectors, or asset classes. High dispersion means bigger gaps between winners and losers. So how does you as an investor identify some of these gaps in real time and hopefully profit from them?
Well, it's all about what's going to drive the future, and that's the tricky part, isn't it? Picking what's going to happen in the future. And so typically what we look at are recent trends that matter for the future. And one of the things we look at a lot are what's happening in earnings. So we just got through a big earnings reporting season in the U.S. and outside the U.S. actually, and that gave us a lot of insight into those dispersion questions. You have to ask yourself, where do I want to identify the dispersion? Mm-hmm. So something I look at a lot is U.S. versus non-U.S. stocks, and then within U.S. stocks, what styles of stocks.
Does that mean you need to be a more active investor versus a passive investor if we do see greater dispersion among certain companies or sectors?
The efficient market hypothesis would tell you no, that you can buy a cap-weighted index and hold it, and that's a perfectly reasonable answer. You can do a little bit better if you take advantage of dispersion, but that's where model portfolios come in.
I want to ask you, and we can get into model portfolios too, because I know that's something you're passionate about, at least interested in. But you were mentioning earnings season and some of these trends. I'm really interested if you could break down some of what you're seeing right now.
Yeah. So, if you take 2025, the year we're in, and look at what analysts expected for U.S. equity earnings growth for the year. At the start of the year, we were looking at about 12% expected growth rate year over year for earnings. And that has been downgraded to about 9% now. But if you look at the path of that, there was this kind of steady drift downward in expectations through the year. And then after this reporting season that we got in July and August, it's lifted up to 9 from a nadir of about 6. Go outside the U.S., and this number at the beginning of the year started about expected growth of 9%, and that's now at negative 3% growth for 2025 for developed non-U.S. stocks as compared to positive 9 at the beginning of the year. And what happened in this earnings season is it went from negative 1% to negative 3%. So when we got the update of the data, analysts used that update to say, you know what, it's actually a little bit worse than we thought outside the U.S. And then within the U.S., they said, hey, actually,
because that was a huge thing. Everybody was like, for a few months, everybody had to be in outside the U.S. It was anything but dollars, but you're not necessarily seeing that now.
Yeah. Well, the dollar has made it so that non-U.S. investments have been more profitable for US-based investors this year, right? Because if you buy non-US stocks and the dollar depreciates, since those non-US stocks are non-dollar, you get that currency appreciation if the euro is appreciating, for example. So that even despite this kind of weakening in the earnings outlook for non-US stocks could be something assisting returns for US-based investors.
And we were just talking about the Sell America trade, everything we saw earlier this year. In hindsight, of course, it's always 2020, but I'm curious from your perspective, through your investment strategies, what do you make of all the panic we saw in the first half of the year and how that was reflected in different parts of the market, whether it be bonds, the US dollar, or even particular
And maybe the hugely quick comeback,
Yes.
Yeah, well, it's complicated because when you look at what was happening for non-US stocks, it actually started before the turn of the year. There was I mentioned this estimate revision that we saw with the reporting that just completed. We saw the same thing last year. There was a series of data that came out with the reporting outside the US that was quite strong. And so it led in the models that I manage us to overweight non-US stocks late last year, which was a good thing for performance. So there were indications prior to the Trump administration that putting a non-US exposure on made sense. So it wasn't just about some of the news flow. And then with respect to what was it? It was Liberation Day.
Oh, right.
Right, Liberation Day. One thing we looked at was what happens historically when you have a market downturn of more than 15% in the US in a period of 2 months or less.
Yeah.
And
I love these studies.
These are great because it's very easy to do. Don't ask ChatGPT to do it. It'll lie to you.
Not prepared.
It'll lie to you. I coded it up.
It still says former President Trump sometimes.
Yes.
Okay. But when you run the numbers properly, what you see is that in those periods where the market goes down very sharply in a very short period of time, very sharply being defined as 15% or more in a period of 2 months or less, the stock market's subsequent 12-month return is 27%.
Wow.
Which is huge.
I mean, we just got that in 2020 too, so maybe not the hugest surprise. And maybe that's kind of conditioning people to think, oh, well, we just had this huge downturn. All right, we're going to be fine in a few months. I did want to pivot to AI though. What do you see in the AI trade? We know it was all NVIDIA at first and the Mag 7, and now utilities picked up this year. What parts of the trade do you really like going forward?
I like the parts of the trade that have earnings forward earnings growing from it. So, there's a lot in motion, and the AI stack, so-called, consists of a lot of potential companies. You mentioned utilities. There are the chip makers, there are software makers. And so getting exposed to it can be challenging. And so in the models we manage at BlackRock, we're using an active exposure. It's BAI, the BlackRock AI ETF, because you can't really index this. This kind of sector really didn't exist a couple of years ago.
So it's too fast moving.
That's right.
And you kind of just have to be. So tell me about your job then. Are you using a mix of different BlackRock ETFs and you're just trying to figure out what the best mix is, or how does that work?
Basically.
Okay.
Yeah, and there are models that I run that have third-party ETFs and third-party funds in them as well. But if we talk about what we call the target allocation ETF model, which is our big flagship model that consists of iShare ETFs.
And when you look at investing in AI companies, do you view that as offensive or defensive, or both?
Good question.
Well, it depends on where you sit, right? So if you're sitting in a position and you're concerned that AI is going to refactor you out of a job, then it could be defensive if you have some capital to put into AI companies. So if there's a shift toward capital from labor and you have some of your own capital, you might want to put some of that personal capital into the AI trade.
Wanted to touch on modeled portfolios and the construction. This is something you're interested in and kind of teased it before. How do you look at this? Because this is kind of a new way to approach the markets that we've seen over the last decade, right?
Right. Yeah. There are a lot of reasons for why model portfolios have come to the fore in financial advice. One of the reasons is a movement among financial advisors to be actual financial advisors that are fiduciary to their clients. So I'd say around 2010, we saw this begin in earnest. And so what used to be brokers who were compensated through commission,
different
retrocession fees on mutual funds, became explicit advisors to clients who collect a explicit fee for the advice. When that happens, a whole series of behavioral changes occur in terms of how the money gets managed, because there's not a load fee on the mutual fund that your advisor or broker put you in. Now, when you're with a financial advisor, you're generally not going into load funds with front loads on them.
Yeah, follow the incentives is basically where we're going, right?
And so then the advisors need to know what they're doing with these no-load vehicles. What would be a good no-load vehicle? An ETF, right? So ETFs become much more popular when you make that switch. And so that movement toward fee-based financial advice, fiduciary financial advice, is well underway in the US. And as advisors make that switch, the most successful ones are adopting a model-based practice because it's scalable, it creates a consistent experience, and it creates better performance, and they can control fees well with it.
Interesting.
Yeah.
Yeah.
Go one more before the break.
Yeah, one more for the break. Let's talk AI some more because that
Okay.
seems to be the word of the day, the year, the month, however you want to look at it. But what concerns you about the AI trade? Obviously, we've been hearing a lot about supply and demand, maybe some of the talent struggles there. Are there any risks when you expose yourself to these names?
Well, they're volatile. And so, you look at a name like NVIDIA or, any of the other Mag 7 type names, and they're volatile. And you need to be aware of that. One thing we do at BlackRock is we look at the risk factors that are underlying the portfolio and seek to balance them out so that you're not driven by single name risk and you're rather seeing a variety of dispersion of risks balancing out your portfolio.
All right. We need to take a short break, but coming up, we're going to be talking about a barbarous relic boasting a 40% return this year. Yes, that's gold. And an AI-fueled runway showdown. Stay tuned. This episode is brought to you by the number 1,045. That's how many tons of gold that central banks around the world bought in 2024, which was the third year in a row, by the way, that number topped 1,000 tons. And to put that in perspective, that's 33,600 ounces of gold, which would be worth $124 billion at today's price. But we want to talk about gold in the portfolio. And how do you see an allocation to gold right now?
It's something we like right now. And the thing you're flagging here, which is the central bank bid, is very important to that. That really started in earnest in 2022. You might think back to what was happening in the world in 2022 and remember all the
Russia, Ukraine
conflicts and the responses to that. And so the central bank purchases are big numbers, and they've been outsized since then. It's a phenomenon that we think is ongoing, and that's important. One thing about gold is they're not making a lot more of it. It's hard to get it out of the ground, and so it's what economists would say has a very inelastic supply, and so it's very responsive to changes in demand. And so we have essentially a new source of demand that's explanatory to why gold's been appreciating so much in recent years, which is central bank purchase. We're also seeing purchases from retail this year that we didn't see last year.
Costco
ETFs.
Bars as well.
Oh, that's
There's
true.
a lot of different ways
if you can
to get
find one at your
gold.
Costco,
That's
sure,
true.
yeah.
But speaking of the central bank, you flagged in your notes to us that sometimes people focus too much on monetary policy. And I feel like that was an appropriate question because it is Fed Day. What is the issue on being too obsessed with the Fed?
Well, I think it's a shortcut to understanding, what's happening in the world. The Fed is responding to what's happening in the economy and trying to make adjustments that are appropriate given what's happening in the economy. But it's the economy leading, not the Fed typically. And that's as it should be. The Fed should be boring like a utility. Banking should be boring, right? It should be like a utility. We saw what happens when banking gets exciting in 2008.
Yes.
And that's not the kind of excitement we want. And so I think the same is true with central banking. It should be boring. It should be responsive to what's happening in the economy rather than creating what's happening in the economy. Nonetheless, it's super important for markets. It's super important for the economy. So I think understanding that's contradictory reality is tough.
And it hasn't been boring, really, with this administration and the issues of Fed independence.
Right.
And
Oh, I mean, wouldn't you love to be a fly on the wall at today's meeting with Myron in there? And who knows what's
I'm
going
sure
on?
he has a true social ready no matter what the decision is. But what are the risks there, too, with Fed independence kind of more a part of the conversation this year?
It's central to how the Fed manages the money supply in the U.S. is to count on its credibility. And so
Credibility, sure.
that's super important. the Fed has historically made adjustments to its strategic plan. So there was a change recently to put away what was called average inflation targeting that happened this summer, right around Jackson Hole. So, historically there have been changes in strategic direction for the Fed. So I think we should tolerate some movement, but it is interesting to watch.
Yes, it is. We talked about gold before. I want to bring it back to the markets. Let's talk about digital gold, crypto. Where do you see crypto fitting into the landscape for investor portfolios, and what's on your horizon here, especially with the rise of stable coins and just putting it all together like that?
Yeah. Well, stable coins would be one thing. What's not a stable coin is Bitcoin. So Bitcoin's quite volatile.
Yes.
And the outlook for it, we have a favorable outlook at BlackRock for Bitcoin based on its role as sort of digital gold. So a store of value that investors can utilize that is similar in kind of the justification for putting your money to it as would be for gold, right? It's something that you believe in, and so it becomes a self-fulfilling store of value. When you listen to end investors nowadays talk about gold and talk about Bitcoin, you could quickly mistake that they're talking about gold or Bitcoin for any one. Basically, the ideas behind them, to protect yourself, to get outside of the base currency, are very similar.
But they do behave differently at different times. I noticed, I track correlations of Bitcoin specifically with different markets, and sometimes it's tied with stocks and sometimes it's not. Yeah. And then gold seems to trade on its own, and it seems to be more stable, at least the way it trades per the way it's done in history. How do you try to model crypto and fit that into portfolios given its dynamic range here?
Well, it a little bit goes a long way. The similar thing to gold, right? So if you look at the amount of price movement that happens on Bitcoin relative to the stock market, it's pretty high.
Sure.
And gold has what we call volatility that's high as well. So a little bit goes a long way. And so then the question is, well, do I strategically or over the long term believe in this asset class as something to park some money into? That would be question number one. And then question number two would be, on a near-term basis, do I think this is a good season for it? What you want to avoid is crypto winter. When Bitcoin goes down 40%, that's to be avoided. And so one thing that we work on at BlackRock are short-term timing models that can help make decisions about, hey, are we going to not experience that?
We're going to have a 90% drawdown.
Yeah,
we'd like to avoid that.
Something I'm looking out to.
Yeah, and I guess related to Jared's question, is it risk on? Is it risk off? To your point, sometimes it trades on either side of the equation.
Where do you think it is right now?
Yeah.
I think it's a risk on asset. And one thing we saw earlier in the year in terms of flows, there was some negative correlation in flows between the spot Bitcoin ETFs and the gold ETFs. So there does seem to be some kind of interchange between. I mentioned that people are thinking of it interchangeably. Well, it seems like they are interchanging gold for Bitcoin here and there.
Interesting point, though. We got to move on to our runway showdown. So spotlight's up. Today, it's all about the AI investing angle. On the left catwalk, we've got racks and stacks, power and pipes, the quiet muscle, data centers drumming, chips glinting, cloud racks rising. They don't dazzle, they deliver, lifting throughput and margins one server at a time. And on the right catwalk, we have killer apps, click and wow, the sizzle on top of the steel, co-pilots, agents, vertical tools, all turning prompts into productivity, cost into speed. In a market of high dispersion and big Fed cross currents, who is wearing today's investing backdrop better, Michael? Is it the pickaxes fueling the boom or the polish that wins the user, racks and stacks, or killer apps?
I'm going to have to go with racks and stacks here.
You like the picks and shovels?
I do.
Yeah.
I do.
And they've won this year. The utilities have been big there. What's anything that you can tell us inside, or maybe a little bit more specific inside that trade?
Well, it's tough to time this stuff. You want to really just get a broad exposure to the theme. And so that's why we're using this active ETF. When you look inside of an ETF that's AI focused like BAI, you see some software, you see some hardware, you see some of every kind of industry that is participating in this trade. Whereas if you look at something like a capitalization weighted index in technology, you get a lot of things that are not AI related in that. So not directly. So if you want a dedicated exposure, take a dedicated exposure.
Gotcha.
Yeah.
So you're bullish on really the ripple effects outside of the typical AI companies that we talk to. And I guess where do you see opportunity beyond the Mag 7?
I think longer term for AI, AI can enhance revenue. So we had during the earnings season, there was one major Mag 7 company that delivered a revenue beat, and that was driven by an AI release that happened mid-quarter for them, and that was a top line result. And then for firms kind of throughout the economy, think of in retail, as they get their data systems put into systems that give them visibility to every SKU, using AI to come up with marketing and sales plans that could also be pretty important longer term and move this kind of benefit, the visibility, the benefit to earnings for a lot of sectors.
One of the things I'd like to talk about here is risk management. So I'm just wondering how you take into consideration of risk management as part of your job, and maybe a lesson for the viewers, how that would apply to them too.
Sure. Well, the model portfolios that I manage are organized around how much risk they have, and we typically anchor on how much equity there is. So most of the volatility in a individual or advisor portfolio is going to be correlated to how much stock they have versus bonds and cash. And so that's decision number one is how comfortable are you with that long-term equity risk? You need to be able to hold stocks, stay in the market rather than try and time the market. So longer term, making that decision is point number one. Then point number two, once you've made that decision, making sure that you've got a portfolio that's consistent with your appetite for risk. So not getting assets or specific exposures into the portfolio that are going to really change what you've got versus what you expected. No surprises.
All right. That's actually going to do it for the show, but I do want to do a brief recap here. We learned a lot about dispersion, and especially that international trade that seemed to be blowing up in a positive way earlier this year, maybe lost a little bit of its shine. So you got to keep tabs on what's hot here. And also thinking about some of the, not only digital gold, but also physical gold, the central bank bid, how that has been really a factor that's boosted gold prices over the last 10 years, starting with Russia and China, and then how that's kind of morphed into the crypto trade as well. And then I love to talk on model portfolios. And one of the ways I got started in this business was looking at various broker dealers and how they were merging with investment advisors. So that's always interesting to dig into as well. So that is all we have here for Stocks in Translation. Be sure you check out all our other episodes of our video podcast on the Yahoo Finance website and mobile app. We're also on all your favorite podcast platforms.